Welcome to our discussion of Your Retirement by the Fortune Knowledge Group. I'm Myron Kandel, and joining me are 5 of the top financial advisors from all across the country. From Chicago, Bill Geiger. From Columbus, Ohio, Greg Taylor. From St. George, Utah, and Las Vegas, Nevada, Abe Ashton. From Oriental, North Carolina, Gary Mastro Donato. And from Mesa, Arizona, Damon Roberts. Damon, let me start with you. What kind of advice do you have for investors in the year 2016?
I'm going to go with some tax advice. I think that our national debt is so high that taxes need to be addressed, and so they're going to go up. And so I'm going to advise people to look at doing some Roth conversions.
Gary?
I'm going to go with cautious is in the wind. You really need to be cautious in 2016. We haven't had a major correction in over 6 years. Statistically, the markets normally correct about 30 to 40% about every 6 years. It's time, way overdue. Additionally, with the debt being so high, additionally with all the terrorism going on around the world and all the uncertainty, and certainly with rates rising right now, I think cautious is the real smart way to approach 2016.
I'm going to go with Gary. I mean, being cautious right now is important, but also who you get your financial advice from, risk advice or risk tolerance advice from. In my opinion, it shouldn't be from the market or market timing. It should be from the person staring back at you from the other side of the mirror. You know, what stage of life are you in? What do you feel like you can swallow? What can you tolerate when it comes to losing your money? Knowing that there's been a bull market run for quite a while, and if your wife is standing behind you, then duck and definitely get the advice from her. But my point is you should be really looking as an individual what you think you can handle and tolerate.
That's a good point, Abe. And I would say this also, making sure that where your money is today is in line with your goals, your needs, and your desires, and making sure that you understand the fees you're paying, the amount of risk that you're taking right now, and can you really afford to take the risk you're taking, and do you even know how much risk you're taking right now?
If you're 5 to 10 years from retirement, late 50s, early 60s, you really, really, really need to understand how much risk is in your portfolio. And if at any other time in history, this is a great time to be cautious. I've been worried about this market for the last couple of years, and I advise my clients that every day.
Well, we're in a climate of rising interest rates. So how do you factor that in to your feelings about the future?
Yeah, well, I think that one of the things we forget more than anything is the secret casualty to low interest rates. See what happens when you've got advisors that historically have been averaging 1 to 2% a year in management fees. When fixed interest rates have gotten so low, it means that to give your client the advice to go fixed or go conservative, you can't make any money. Your client can't make money, and therefore giving them that advice is actually going to destroy the type of returns that even an investment advisor is going to make. They can't afford to give that advice because there's no money left on the bone, if you will. And so people have been given advice to stay riskier than they probably should. And that's been one of the issues of these low interest rates. And we probably will see them continue to climb a little bit, but they're still so low that you've got to be careful when an advisor is telling you, don't go fixed. Are they getting that advice for the right reason?
You know, let me add to that the fastest growing segment of the mutual fund industry are target date funds. And target date funds, by definition, the older you get, the more money they move from equities into bonds. And in a rising interest rate market, we all know what happens to bonds. They head south. So that's another real area to be cautious about.
That's true. And you know, that kind of leads us into what I call right now the perfect storm, because whenever the Fed starts threatening to raise interest rates, what happens to the markets? They start really going all over the place and heading downward. And as soon as those interest rates go up, as you mentioned, bond prices are going to fall. And that's really that perfect storm, because where do you shelter your assets today? If they tell you to put half of it in stocks and half of it in bonds, if neither one are going to be protected, now what do you do?
That's why it's so important, Myron, that we take a look at a different approach in this economic environment, which I call the endowment approach of investing, to really make sure that we're using the right asset classes at the right time. Bonds right now are not the right asset class in this market. Alternative investments may be. Safe money will be. And a small amount has to stay in institutional, professionally managed money to offset inflation. Now, interestingly, the government says we don't have inflation, and thus all of our retired Americans at home right now that are on Social Security, sadly, are not getting that big raise in Social Security at all. The net result to our retired American is less money in their paycheck, and that saddens me, and that's why I'm in this business today, working extremely hard to help clients and listeners to our programs really educate themselves on why they need professional advice.
One of the problems is convincing your clients that in this uncertain environment, they have to be more cautious. How do you respond to that?
Well, I think the thing you have to do is help them understand what risks they're taking and ask them, what would another 2008 do to you? And a lot of people say, well, you know what? After 4 or 5 years, I was made whole. And that's perfectly fine for the 30-year-old or the 40-year-old or even maybe the 50-year-old. But that 60 or 70-year-old, can they afford to ride out another storm and possibly watch half their nest egg disappear while they're trying to make it through retirement?
Yeah, and not only that, but are they taking distributions now?
Right.
Are they taking income? They've maybe recouped some of those losses from when they were still working, and they probably had contributions from their jobs as they were trying to
Right.
get back to
Which
sea
got them
level.
back
Right,
faster.
but now it's a reverse when they're starting to take distributions and income, and you have another market loss, or trying to recover from a catastrophic effect of a market decline. You just can't get there.
Even without the reverse dollar cost averaging, which I think you're talking about, it's like going for a walk through the woods and you fall into a hole. It takes you 5 years to climb out of the hole. Now, it's really nice to see daylight, but you've made no progress during that time. And if you're retired and taking money out, you're eating away principal.
You've also got a big problem, Myron, with what we call sequence of returns today. Imagine the retiree walking out of the shop for the first time, just got the gold watch, and ready to turn on that first retirement check, and the market correction simultaneously, like back in 2008, touches his retirement account to the point of a down 30, down 40, down 50%, and you're pulling out 5 or 6% for income. Additionally, we've got to look at those tax returns. I think, Abe, you mentioned taxes. You've got to look at those tax returns on 3 specific lines. You've got to look at your capital gain line. You've got to look at your dividend income line and your interest income line, because many retirees out there are paying taxes on money they're never using. We can take those dollars out right now, literally tax-free, because they've already paid the tax anyway. Let's use that money for smart money, tax-free investments, tax-deferred investments that grow in a tax-favorable environment. And there's a lot of ways to do that. We need to help our client by education. Taxes are so crucial, and taxes have to go up. So we've got all these factors working simultaneously. And all of a sudden now, here we are smack, just about to cross into 2016. And our clients need us more than ever.
Damon, one of the questions is, in recent months, we've had really substantial market swings. Volatility really upsets many investors, right? And you were talking about education. How do you deal with that?
The education is key, and as you know, one of the things that we were just talking about with everyone is this resistance sometimes you get from people wanting to be more conservative. And if you're working with a couple, one of the things you definitely need to do is ask the wife. Our wives the women out there typically know that they need to be safer, and they're able to get us men usually to kind of take a step back and to do that. And so making sure you're looking at a couple, looking at an individual, understanding their needs, and then being able to address things so that they both get the education, they can make proper decisions together. When you lay it out for them step by step and you can help them see the vision, then typically they'll understand and want to follow that vision.
Abe, you do a lot of your work in Las Vegas.
Yeah.
People in Las Vegas are used to big swings.
Sure.
Whether they're on a roulette wheel or the table or whatever.
Yeah.
How about your people? How do they relate to the fact that the market has had these big swings lately?
They don't like it, and you would think that they'd be a little desensitized to the risk because of gambling being there, but in Las Vegas they took one of the biggest real estate swings from 2009 through 2012 where home values lost 50%, 60% of their home values, and it ate people up. And I said, well, we're in Las Vegas. Gambling is gambling. You're playing red or black and roulette, but they don't want to do it with their home. And they certainly don't want to do it with their retirement account. So when you educate them, and it's making sure they know what things are available, what financial tools and what financial products. And as Damon says often, educating his clients becomes way less about convincing someone than teaching them. And if you teach them and show them what's out there, then they'll make the best decision for their family. We have smart clients. They know what they want when they hear it. When we educate them, then they'll make the right choice for their family.
And I'd like to touch on something that you said, Damon, is we have found historically that when couples come in the office together, they make the absolute best decisions. Would you guys agree with that?
Oh, yeah,
They will,
absolutely.
It's almost when they come in alone, you're like, okay, well, come back with your spouse.
Yeah,
You know, him
exactly.
or her, come
Yes.
back with your spouse. We'd much
Definitely.
rather you both
Yeah.
be here together because we know we're going to have to repeat this whole thing all over again. And then they tell you, well, no, I handle these decisions, or no, or she handles these decisions, or I handle these decisions. And the truth is we're much better off when they're both there in the
Yeah,
office.
because they're making family decisions.
They do, and you want to take the emotion out of it for them, because whenever either fear or greed drive the decision making, big mistakes are made.
I'm going to ask you a tough question. Why do I need you guys? Why don't I just put my money in an index fund and go to sleep? What's wrong with that?
Fees, number one, very expensive. Number two, you're walking into uncharted territory, especially in this kind of market environment. An index fund right now could be catastrophic to your portfolio. You may have to work till you're 85 or 90. You just can't do that. And additionally, some people actually out there now are focusing more and more as the retiree gets a little bit older, to the family, to the legacy, to the planning portion of what we do as well. Family legacies are so crucial today. And many, many people in my area, Myron, don't have children, oddly enough. And they have no one to leave money to. So we're educating them on charities, setting up endowment funds, educational funds to carry on the torch of what they've put together through their lifetime. And right planning could be the right way to go. You don't get it with a index fund.
We ran the numbers the other day. We're trying to figure out just how intelligent that might be. And if you go from January 1st of 2000 until now, the average return on the S&P 500 is 1.85%. 1.85%. You could have bought a CD on January 1st of 2000 and done better and slept well at night.
Index fund, you have no one-on-one contact. In your work, I think the epitome of your work is one-on-one contact.
Sure it
How
is.
important is
Sure
that?
it is. And I just began working with an OBGYN doctor that just retired. And he said, Greg, I looked up all this stuff on the internet. And, I'm not quite sure that I really need to deal with you. And I said, well, are you going to self-diagnose yourself? And he said, what do you mean? I said, well, how about if you had a patient just went home and searched up all the answers on the internet, and they're going to self-diagnose all their problems, and they no longer need you as a doctor? He said, okay, I get the point.
Yeah.
That's a good point. And we don't have any impulse control anymore when it comes to our investments. It's so easy to buy and sell stocks to make an emotional run. And that's really what we can help people with, is help them decide not to make an impulse move.
That's an interesting point, because a lot of people thought that's a big plus, getting instant trades. But you're suggesting that maybe that's not so good.
No.
Gary, what
Well,
about
well,
that?
instant trades are really not the point. In my practice, Myron, I haven't bought or sold a stock in probably 20 years. We position money for to help them reach their financial goals. We want to know what their goals are, where they're headed, and how they plan on getting there.
What about communication? Some of you alluded to that, but how important is communication in investment advice?
Communication is key for your clients, for our clients. We want them to know ahead of time, this is the plan, and when the market goes down, this is what we're going to do. When the market rises, this is what we're going to do. If this happens, this is what's going to happen.
Yeah, and you've just brought up the number one reason why people fire their financial advisor. It's not about returns. Many surveys and studies show that it's a lack of communication. A customer, one of our customers, cares way more about our communication with them and how frequently and how right. Even if investments are down, even if returns aren't where they want them, right? It's
Yeah.
about a lack of communication. So the advisor that communicates regularly with their client will hold on to that client, will hold on to that customer.
Greg, another aspect of communication is within the family.
Well, that's absolutely right. Talking to their kids and getting the whole family together. I can tell you how many times we've had 8, 10, 11 people in a conference room and helping them understand this is what mom and dad have. This is why they have it there. Making sure that it gets translated to the kids and to the entire family, because there's a lot more power to it when the whole family understands why the money is there.
That's what we do every day.
Yeah,
Right?
exactly.
That's
That
our
is.
goal, is to help people sleep well at night. And we find that when our customers understand the worst case scenario, they can plan and enjoy life. You know, if they go to bed at night knowing, I know if things go down, I know if things fall, I know what my worst case scenario like, so now I can hope for the best.
Right.
I can make some plans according to historical returns and whatnot, but if we can show them what the worst case scenario looks like and they can live with that, if they can stomach that,
Exactly.
then the rest of it, everything else is gravy at that point.
Their portfolio needs to be structured so that it's more or less bulletproof.
Yeah.
That you can go through a really bad time in the market and it doesn't change their future.
And Myron, it's an incredibly fulfilling job that we have.
Yes, it
To look someone in the eyes and tell them, you can get there from here, you made it. You crossed the finish line. You don't have to go around the track over and over again. The checkered flag waved a couple laps ago. You've done it. And to watch people walk out of our offices 2 or 3 inches taller than they walked in, with a little bit of knowledge, with a lot of education, and knowing that we can get them there from here, it's a great job.
Well,
We had a
that's the
couple.
Sherpa. That's the Sherpa approach of helping people back down the mountain. They work their entire lifetime
To get
up
up
to
the
the
mountain.
top of the mountain. Now, how do you get down?
Abe, what
And
you were
they
just
need
saying.
that Sherpa.
We had a couple that we finally put together their financial plan for their retirement. They left our office outside the reception area and they hugged and kissed each other.
That's awesome.
That's very satisfying.
That is good stuff.
We just have a couple of minutes left, and I'm going to start with each of you. Damon, start with you. What advice, in very short words, do you have for investors entering the new year?
Don't procrastinate your retirement. Get started now, get a plan together, because the more time that you have to work it, the better off you'll be.
Communication. Communication is so key right now with not only their advisor, but with each other, and to really know the rules of the road.
Whatever we can do for our clients to help them, will be better off if we help them in the first quarter of the year. If we want to make 2016 a great year, using the first quarter to help with taxes, to help with investments, to help with different strategies. So make that your New Year resolution, to come in, seek a trusted financial advisor. We can do a lot more for you in 2016 in Q1 than we can at the end of the year. So make sure that resolution is fulfilled this year.
Absolutely, Ed. Get started today. And make sure your plan's complete. Don't leave things undone. We see it so much that they have a little bit done, but they don't do everything. And understand what your risks are, what your fees are, and then get busy and have the retirement plan that you've always dreamed of.
Have a game plan. It's more important than ever before. And really, really, really understand risk. Understand how much risk you have in your portfolio, and what's the upside, what's the downside. I talk to people all the time. If you made an extra 10%, would that change your life? If you lost 50%, would that change your retirement? So you have to be cognizant of risk, and you have to put a plan in place.
And that's all the time we have. Thank you, gentlemen, for joining me. And for our viewers, be sure to join us next time on the Fortune Knowledge Group.